Hi, Chicken Gang. We all know in 5 years, disruptive and innovative companies will probably double or triple in stock price. Meaning if you put 1 million, in about 5 years, you will have at least 2 million. Of course, those companies must fulfill the 2 criteria I've given you. Do you remember? I repeated this like a gazillion times. Number 1, a proof of concept, and number 2, the ability to scale. If you choose to deviate, good luck to you. By the way, watch to the end and I appreciate the early thumbs up. Lately, growth stocks are kind of flat. It sucks. And the truth is, it has to do a lot with cost of equity. I'll explain later. I hope you understand that last year was a freak year and stock market is trying to normalize. Last year, my returns was like 1,000% non-leverage. In a year like last year, as I said this before, if you are a guru or expert, your returns are anything less than 100%. For the good of people listening to you, just retire. Last year, any donkey would have made money. You need to make good money in good years because if the market turns bearish, how are you supposed to recover your losses? A simple risk to reward ratio. Okay, back to the cost of equity. The cost of equity is the return a firm theoretically pays to its investors, i.e. shareholders, to compensate for the risk they undertake by investing their capital. The formula for cost of equity is risk-free rate plus beta multiplied by market risk premium. I do not want to bore you with too much of the numbers. If the 10-year treasury yield goes up, represented here by risk-free rate, the cost of equity goes up. If the cost of equity goes up, it puts pressure onto the stock market. Anyway, think of it this way. If you are buying a house and the bank quotes you 1% interest on your loan, it is not so bad. If the bank quotes you 10% on your interest, you will think twice. In a 10% interest scenario, what needs to happen for you to buy the same house at the same price? There's only 2 factors. Number 1, you go make a rich girl pregnant, or number 2, your salary needs to go up. Salary needing to go up is represented by GDP. You hear this term GDP everywhere. GDP is calculated by adding up all the money received by everybody. And here is a chart of GDP. Only twice it dipped during the 08-09 financial crisis and recently the pandemic. I want you guys to guess, will this chart go up or down from here? It is very obvious. So what's happening now? As cost of equity goes up, it puts a lot of pressure onto the stock market and in particular, growth companies. This is causing the sideways movement of the stock market, and what needs to happen now is salary needing to go up, meaning GDP. This is pretty simple. We all know what's going to happen with so much money in the economy. The stimulus package is massive. Remember, GDP is calculated by adding up all the money everybody is receiving. So GDP will shoot up and the stock market will fly, represented here by this formula. It is the best time to add because buying stocks when the stocks is flying up is really hard to do. And there will be times where the capital markets need to take a breather, and this is one of those times. These are the times when stupid and new investors fade away, leaving the smart ones. The weak companies will start to fracture because less stupid and new investors to buy into them.
Listen, I'm a piece of garbage. I lied to everyone.
So for you, what you need to do is to invest in companies you understand the most and let time do its job. And that's all for you to be greatly rewarded. For me, I'm more bullish than ever in Tesla as a company. As a Tesla investor, please watch this 11 minutes video by Dave Lee. It is worth your time, and you know I hate wasting your time. I'll link the video below. I hope you have a better understanding of the stock market, and this is the most simplified version I could do on this topic, else there will be many formulas for you to digest. Appreciate the thumbs up earlier in the video. Thank you for supporting my causes, and as always, invest safe.